Good afternoon and welcome everyone. Thank you for joining in for the virtual budget seminar 2021. ICEMA has joined hands with Deloitte as its knowledge partner to bring to you ICEMA's post-budget analysis 2021. Observing the COVID-19 restrictions, the ICEMA post-budget analysis session is being organized on a virtual platform, allowing for a much wider participation. For our guest from Deloitte, I am Jaswinder Bakshi, convener, finance panel, and treasurer ICEMA, and Senior Vice President, Tata Capital Financial Services Limited. Let me start with introducing our guest from Deloitte. We have with us today Mr. P.S. Iswaran. Iswaran is a consulting partner at Deloitte focusing on industrial products and services. He leads the supply chain and network operations offerings for the Asia Pacific region with the responsibility for leading and supporting transformation initiatives for the clients. With over 20 years of industry and consulting experience, he has led engagements across the value chain of segments, including prime producers, system integrators, suppliers, and startup ecosystem partners. We also have Mr. Gokul Chaudhary, who is Deloitte, a global leader, business tax and partner with Deloitte India. In his career span of almost 30 years, Gokul has focused on delivering value to client engagements, engaging on tax policies, and formulating tax strategies. His experience is primarily on corporate and international tax services, including significant engagements for domestic and international clients, in particular multi-billion dollars, cross-border transactions, privatization initiatives, and project advisory for large infrastructure project assets. The session will be moderated by Ms. Beth Mao. Most of our members know her already, who is a partner at Deloitte India, a chartered accountant by profession and an alumni of Indian Revenue Service. Her professional experience includes working with government as a tax officer, tax consultant in a Big Four company, and then with the industry as a business tax advisor. Additionally, the subject matter experts for today's webinar are Mr. Shripal Lakdawala and Mr. Amit Sarkar for direct tax and indirect tax, respectively. Shripal is a chartered accountant by profession and specializes in M&A and has vast experience of advising clients on corporate restructuring, domestic and cross-border M&A, capital restructuring, etc., from a tax and regulatory perspective. Amit is a chartered accountant by profession and has assisted various clients on indirect tax planning and structuring for tax-efficient operational models and ongoing compliances. He also has experience in advising clients on authorized economic operator certifications under aegis of Indian Customs. He also has handled ERP, that is SAP Oracle implementation project as a subject matter expert on Indian direct tax and customs. He also has been part of SAP GTS projects for large multinationals. We also have industry leaders, from the members of ICEMA, like Mr. Anand Sundaresan, Managing Director, Aman India Private Limited, former Vice Chairman and Managing Director of Swing State India. Mr. Anand is also past President and a very active GC member of ICEMA. He comes in with a vast experience of more than 43 years of establishing and managing large companies. He has been one of the main guiding lights for ICEMA and the CE industry. Mr. Venkat Krishnan Natarajan, I think he just joined. So welcome, Mr. Venkat. So he's Senior Vice President and Chief Financial Officer, Tata Hitachi Construction Machinery Company Limited, and an active member of ICEMA's finance panel. Mr. Venkat has more than 3 decades of experience in finance and taxation and is industry's go-to person for any matter related to taxation and financing. I also welcome Mr. Murli, Chief Financial Officer of Volvo Construction Equipment Finance Private Limited. Mr. Murli is a seasoned finance professional with over 20 years in the Volvo Group. He has held several senior positions within the group in India and Sweden. He has overseas experience, 7 to 8 years in Sweden as Director of Finance and Accounting. For a few years, he also was Director of the Volvo Eicher commercial vehicles. It's an honor to have all of you for this discussion today. ICEMA has become a global voice in the government and industry circle and has been working towards voicing and addressing the industry concerns to the relevant departments. On 23rd of December 2020, Honorable Minister of Road Transport and Highways and MSME, Mr. Nitin Gadkari, launched a construction equipment industry vision plan for the year 2030, aptly named Building the Nation. Our first such association to formally launch not only the vision, but also the concrete steps we as an industry would be taking and our asks from the government, which will make this vision a reality. We as an industry aspire to be USD $20 billion plus, which is almost tripling our sales numbers in the coming 10 years. The vision plan document is a detailed document which will help not only our members, but also other stakeholders like vendors, distributors, financial institutions, banks, rating agencies, and consulting firms to help forecast and plan their activities for a wonderful growth journey. On 7th of January, ICEMA was also invited by the government to make a representation to Parliamentary Standing Committee on Transport, Tourism and Culture, which we feel shows the credibility the association has built as an industry body. So this year's budget has a clear focus on healthcare, welfare and infrastructure. On 7th of January, ICEMA was also invited by the government to make a representation to the Parliamentary Standing Committee on Transport, Tourism and Culture, which we feel shows the credibility the association has built as an industry body. This year's budget has a clear focus on healthcare, welfare and infrastructure with a very clear fiscal and economic strategy. A lot of positive announcements have been made on the allocations for the infrastructure, which is our parent industry, an all-round investment plan for roads, railways, ports, urban power infrastructure is envisaged. Today's session, we would like to understand and decipher what it means for all of us as an industry. So without taking much further time, I will hand over the session to the experts. I would request Bella to continue the session, please. Yeah, Bella.
Thank you, Mr. Bakshi. And just to move on, so good afternoon, everyone, and welcome to this online interactive session on post-budget analysis organized by ICEMA. And we thank ICEMA for inviting us to be the knowledge partners for this session. Before we hand over the reins, to Mr. Ishwaran, who will begin with economic analysis and then hand it over to other colleagues from Deloitte, I'd like to take a moment to highlight that all participants are on a mute mode. If there are any content-related questions that you have during the session, please type them in the Q&A chat box, and we will, on the right of your screen, and we'll do our best to respond to it during the Q&A session. We also have a panel discussion after this presentation, where some of those queries could get addressed. So with that, I hand it over to Mr. Ishwaran to begin the presentation. Ishwar, over to you.
Thank you, Bella. Thank you so much. Thanks for the introductions, Mr. Bakshi, and to the industry leaders for having graced the occasion, and to our partners at Deloitte for joining me on the panel. I just thought before we get into the specifics of the budget, give you an overview as to the context in which the entire budget came in. What's the current economic scenario? Where are we seeing the landing points? How are the macroeconomic parameters moving? And therefore, as leaders of industry, what would be the big areas that would be of significance to you? So if you really look at the last 5 to 6 months, and if you had browsed at any point of time as to what the Indian economy's growth rate would be, every analyst has actually changed positions towards the positive end of the spectrum every 3 to 4 months. And I took the 5 or 6 major ones who report global growth rates across countries. And one of the good things that I noticed is that as they went over year on year, month on month, every month about 100 basis points or at least a percentage of the GDP started improving. So if you really look at what we are thinking of right now and the way we are starting off, and the latest came in January of 21, which is, let's say, about 15 days before 20th of Jan, everybody is talking about anywhere between, let's say, about 10% to 13.5% or 13%. And it's very likely that, we may end up with about 10 to 12%, more likely towards the higher end of the 12%, given that the vaccination model is working pretty well too, both in terms of the economics of the model as well as towards the resilience from an India perspective. Very similarly, and that's for the coming year is what I'm talking about. And very similarly, if you look at this year, We started with a contraction of roughly about 13%, 12.5%, 13%. Today, most of them have started moving towards, and especially those who have reported in January, have started moving towards 7.5%, 8% contraction. And my own personal expectation is that I think as we go towards the next couple of months with the budget in perspective and some of the accelerations that we will talk about, and Gokul will in very specific terms talk about some of the financial infrastructure models, and a couple of other SMEs leaders will talk about the rest. You would also see that we are really maybe pointing towards a contraction of just around 6% or so. So that's the context. We started off with a contraction of about 13, 14%, and then we are talking about literally about 6% for the end of the year, which really shows as to how the needle has moved as far as the economy is concerned. And very similarly, therefore, the projections that are coming in terms of what the next year is going to look like. But my view is, you don't have to go only with what someone is projecting. I'll also tell you as to what the big parameters are and how are the big parameters moving, and therefore how are they feeding into the discussions on the budget that we spoke about, and very specifically to our industry, as Mr. Bakshi said, a significant growth driver with about a $20 billion industry in the next 9 years or so. The second that you would notice, which is on the left-hand side of the curve, is that one of the big drivers of Indian business, and I didn't call it out so appropriately, one of the things that is becoming very relevant in India is the four growth drivers of any economy. We always talk about it in industry terms, but if you really look at it, private consumption, government consumption, total investment, as well as exports, these are the four building blocks. And you would have noticed that in quarter one, there is one pile which is standing up, right? And that pile which is standing up is the government consumption. So what happened is that unlike many other countries, what the government of India did is that the government of India, incidentally, this was about a 16.5% growth rate. And once things started easing off, you would find that the contraction over the prior year and the next period is also not very substantial. Therefore, what they started doing is that a lot of interventions from the government to offset private consumption happened in the first quarter. So many of that also gave the inherent confidence modeling that was required in the economy. And as that started to play up in the marketplace, which you now also see in the terms of the stock market results and as well as in some of the other parameters. So essentially a combination of investment by the government in the first quarter, coupled by some of the movements in the macroeconomic parameters, have really resulted in us looking at something around 10 to 12% growth, which essentially means that we'll have a positive growth rate the coming year in spite of the contraction this year. That's possibly the first lesson for all of us. If you can go to the next one, this will actually tell you as to how, if you can kindly move to the next slide, please. Should I take control? Pooja, if you can go to the next one. Maybe as it comes by, I think, what I will do is, I may not have a slide to talk, but yeah, as it comes by. Right. Now, if you really look at the dimensions which are relevant, where we don't need to really go by what the analysts are projecting. Take 2 or 3 things which are the big drivers of the economy and what would also be relevant for resilience. Take the Purchase Managers Index. So the Purchasing Managers Index is nothing but a reflection of the confidence that the industry has, and it's a lead indicator. And if you really look at the PMI over the last few weeks has really outperformed what it was in the last 1 year, which essentially means that organizations believe that there is an opportunity for us to buy more, process more, sell more in the marketplace, and therefore the outlook of purchasing parameters are pretty high. So that's point number 1 for us to discuss, which is a very sentimental lead indicator. The second one that is pretty important is for us to also look at the forex reserves. Now we talked about the government consumption being 16.5%. One of the reasons that the government is also able to invest is also the confidence that we have in terms of what reserves which are there. And therefore, if you look at the reserves, very surprising that you would not expect this. The reserves have really gone up substantially month on month over the last 1 year, and especially during the COVID period. So let's say we started the COVID journey at about, let's say, 478 billion. Today, we are talking about 585 billion. You would also notice if you take the January data, a lot of imports have actually been replaced by domestic consumption. You can always argue that demand is low, but the demand has just been lower by about 7% or so. It's not very substantial. So that's point number two. The third, if you look at it, the outlook for gross capital formation, especially fixed capital formation, is pretty high, which essentially means we're just not looking at sweating existing assets. And that's a very important dimension for members of ICEMA. Indian industry is really looking at investing in capital formation from a fixed asset perspective, which essentially means that hard assets, be it a combination of Make in India program for the domestic home consumption market, or be it Make in India for the export market, or be it creating infrastructure to enable both of them, the outlook is that we'll have a substantial increase in gross fixed capital formation. The good thing is that the capital formation model has been pretty resilient even in the post-COVID scenario, or rather in the COVID scenario. So you would find that while there is a bit of a reduction, fundamentally the overall model is still very sustainable. So learnings for us is, I think the lead indicators are showing a pretty positive trend from the PMI. The second is, I think there is a strong forex reserve model, which essentially means that the significant depreciation or appreciation of the rupee will not happen. There is obviously a chance for appreciation, because if the vaccine modeling is working pretty well, I think there's a lot of confidence in India. Rupee is expected to, obviously it's doing that already. There's a bit of strength that the rupee will gain. And more important, I think the market model is going to be a lot of manufacturing within India, and therefore value addition within India. So those are three things which would be very relevant from us as perspective. And if you go to the next one, Pooja, where I'll quickly talk about what it has meant by way of the growth from a consumer perspective. We spoke about government consumption initially to drive private consumption. And if you really look at the private consumption, we try to look at two parameters on the right hand side. One is on the durable goods, which is a proxy for urban demand, and non-durable, which is a proxy for rural demand. And both of them really hitting the curve right now, which essentially means that the V recovery that you have spoken about, and literally following a V, right, in this case, the V recovery that you spoke about is already in perspective. And quickly onto the left-hand side, one of the things is this is about where people spent in the prior period and where they are spending now. And you would notice that one of the interesting things that you would notice is there's a lot of spend which is already happening on areas like footwear, on electronics, alcohol still, obviously context of COVID getting stretched. But otherwise, a lot of the others showing a positive trend, which means that people have now started to make the investments that they want. So a combination of good early interventions by the government, strong performance from a macro perspective, including the reserves and the PMI managers index doing well, together with now the rebound of the urban and the rural demand. This is really setting the stage for us to start thinking about the budget. And therefore is why you would find the budget being focused on the supply side substantially. I think there has been a lot of discussion why he's not really putting money in the hands of people directly. It's more fiscal than monetary, but you would really find that with these fundamentals in place, nobody would want to lose the momentum of this and into the coming years, and which is exactly the context in which the budget has been made. And as it was mentioned earlier, the kind of investments that are coming into infrastructure, it's not an isolated model but linked to overall policies of manufacturing, which we'll talk about. So Pooja, if you go to the next one, this is really the context on which the budget came in. So I'm just trying to sort of tell you as to what were the pillars in which the entire model came up. So look at this. If you really look at where the budget is focused on, and specifically the focus on infrastructure has been significant, be it in roads, be it in rail, or in the power and utility segment. All three, if you really look at it, is about enhancing value addition within India. So the theme of the whole model is about domestic value addition, which you will hear at various points as we go by. But that's essentially the model that you would be looking at. Now, one of the things, especially for our members, that would be very relevant is, I'll come to the details as we over the next minute or so before I hand it to Gokul to talk about the financial infrastructure. But one thing that you would notice is that a big area for focus for us should be to look at where to play. And the where to play would mean that where are these investments getting directed? Now, over the past years, the mix has changed. But over the past years, one of the interesting dimensions that we have been able to look at is there is a Pareto in terms of where the investment is getting into, because there are specific areas that the government would want to focus on in terms of sectors in terms of regions for development, because some of them are less developed than the others. There is an equitable model being planned, and obviously there are a set of corridor and related models which are coming up. Therefore, I think one of the things that you may want to look at into the budget and into the details is where is the Pareto and the clusters of investments which are coming in. And ideally, if you look at it, the last time the NIP came up, the NIP was focused predominantly in about 34 clusters out of India. So maybe you would cover about the first 40 and the next 40 cities, which essentially means that you would focus on 80, I would say, corridor lenses for you to work on. So those are in the details, but that is something that I would urge all members to look at. If you really look at what is going to drive our business from an infrastructure perspective, I would only look at about 2 or 3 things. The first, I would really be looking at the PLI model itself, because one of the good things about PLI is, while there is a scheme to encourage manufacturing, it traverses sectors which would mean that you would not have the same Pareto of states where the investments would go in. Otherwise, it was very traditional, right? Between Gujarat, Maharashtra, Karnataka, Tamil Nadu, AP, I think you're safely covered for about 50%, and if you take NCR, you're covered for about 60-65%. I think now the model is a little bit different. Therefore, you may want to really look at how those things are going to drive our business, and this is going to be a big multiplier effect on the market. As you have seen in other parts like the US in the 80s and China in the 90s, and obviously now in the early 2000s, Korea, which was a more silent model. The second one is really where in the second one in terms of textiles, etc., more sector-like. The second one that is more relevant is also the fact that there is a significant impact on the rail sector. And rail infra is going to be a big part of the journey. So when we talk about manufacturing, and we have always associated manufacturing with capital goods, light engineering, etc., including the portfolio we are there, one of the things that would also be very relevant would be to look at how the rail projects are going to go. And rail in all 3 forms. Rail in terms of traditional low speed and high speed rail, rail in terms of the metro which is there, and obviously the new Vande Bharat and the related models which are there, which includes all dimensions, physical infrastructure, signaling systems and electronics, as well as some of the other advanced digital ecosystems which are there. The second that would be very relevant for you would be the power distribution model. The power distribution, obviously, especially if you really look at the outlay is also talking about renewable power, and therefore there is a lot which will happen even within the existing discoms. So that's possibly the second area that you may want to focus upon. And the third, very naturally, I think given the security considerations outperforming economic considerations in the last 1 year, the budget is really going to focus on the public-private partnership models in the ports, which essentially means that our entire equipment ecosystem is going to really be the big driver of change, because efficiency will be the key. And if you look at all these things, the whole thing is to enhance what they call the total factor productivity. India has been lagging on that, and this budget is really focused on enhancing that. So to a large extent, I think the macroeconomic fundamentals are in place. I don't think we need to be worried. I think fundamentally there's a long-term game that the government has taken, which is more fiscal than monetary, and therefore you would find that a lot of focus on roads, rail, ports, and power. And very specifically, I would think that the where to play model for organizations would be where the decisions would become very, very relevant. I think what is also important in this case, and I would request Gokul, our global direct tax business tax leader, to come in, is the fact that we also have a financial infrastructure being created in addition to the physical infrastructure. So Gokul, if I could request your views and thoughts on that, and then we can then take it to the SMEs.
Thanks, Ishwar. This is all very exciting. Let me talk a little bit about what are the type of financial activities that the budget is trying to outlay here, and these are directed materially at the infrastructure sector. Firstly, the government is rightly acknowledging the absence of a debt market in India for infrastructure, and I think the NBFCs have had a bit of a stressed time in the last couple of years. So therefore, the government has talked about setting up a development financial institution, and they put aside about 20,000 crores for funding it. And then the aim is for that institution to be able to raise money, and I suspect that they'll probably raise money bilaterally also from other global sources because they want to try and build up lending capacity of about 5 lakh crores in the next 3 years through the Development Finance Corporation that they're trying to create. One of the other elements which is coming in is that they want to try and improve the frameworks around InvITs and REITs, and the government had been working on this, but there was still a significant number of hurdles which did not allow InvITs to really become a viable proposition. So, couple of changes that they started doing on the InvIT and the REITs structures, which is very helpful. One is that they said they're going to change the regulations so that they can be debt financing of the InvITs by the foreign portfolio investors. That's one measure that they're talking. Secondly, on the tax side, they are saying that dividend paid by SPVs to InvITs, there will no longer be any dividend withholding, so therefore that cash flow issue gets resolved. And then, of course, as the issuer also alluded to, there is a very significant asset monetization program. So the one view which is possibly, if one was to connect the dots here, is that a lot of the asset monetization is going of brownfield assets is going to be done through the InvIT structures, which they have smoothened, and then they will encourage global investors to come into these structures. And towards that, the new investor class that they have been trying to promote over the last year or two, and 8 or 10 asks from those sector, which was the sovereign wealth funds and the pension funds, that the government has sort of agreed to nearly 80% of the hurdles that were being experienced. So therefore, there is the encouragement on to sovereign wealth funds and pension funds to come in because the rules have become easier. They've also opened up the opportunity for infrastructure companies to issue zero coupon bonds so that they can raise another source of funding. So I think one of the aspects is as Ishwar spoke about, there is going to be direct funding of projects, greenfield projects to be by the government, for which they are directly doing a budgetary outlay. But assets that have been created in a brownfield, I think the government is rightly saying we would like to flip them into structures where pension funds and sovereign funds and so forth can come in and hold those assets and leverage of those asset earnings. So I think this combination that the government is trying to build will lead to a far more healthier ecosystem for the infrastructure sector. And I think therefore in this way, the total package that's sort of been proposed for the infrastructure sector is quite a healthy one. Back to you, Bela.
Thank you, Bela, and my partners Ishwaran and Gokul, they have led, they have set the tone right for the presentation and explained on the economic indicators. And moving on to direct taxes, there are a few, while there was not much in the budget speech, but when we looked into the details and finance bill, there were certain amendments which were there. And I will like to touch upon some of these critical amendments or amendments which have a significant implication. To start with, I want to set the context to say that there has been no change in rates of taxes. So the tax rate card which was there for the previous year will continue. And just to say, the domestic companies would be taxed at 22% plus surcharge. And provided these companies do not avail any incentives or tax exemptions. For new manufacturing companies, there is a concessional rate of 15% which has been prescribed. This was done in financial, both these 22 and 15% were done in FY 1920. And if you want to avail 15%, then also there is no incentive or an exemption which is available, and the effective tax rate works out to 25.17 or 17%. Or 17.16. As regards MAT, if you are at the 22% or the 15% tax regime, then the provisions of MAT do not apply. And the effective rate of tax for companies which do not opt for the lower tax regime would continue at 17.47%. So essentially nothing changes on the rate card. If you can move to the next slide. Yeah. So as Gokul mentioned, the focus has been on the infrastructure side, and some of the key proposals which are there from a direct tax perspective, which I would like to touch upon, and to some of the proposals which are there for boosting the infrastructure. The first one, I think Gokul did touch upon all of them, but I'll just repeat to say, there is a mechanism for enabling infrastructure debt funds to issue zero coupon bonds, and amendments in this regard are proposed in the rules and the provisions. Also, there's a setting up of DFI with a 20,000 crore capex and then there's going to be borrowings up to 5 lakh crore, which will be lent to infrastructure companies. One key amendment which is there is lending by FPIs in InvIT and REIT. Amendments are to be made to the regulations so to enable FPIs to invest into debt of REIT and InvIT. Coming to the sovereign wealth fund, in the last budget, they had proposed amendments whereby specified sovereign wealth funds and pension funds, were given exemption from income in form of dividend, interest, and capital gains, if they were to invest into infrastructure companies. Now, and there were certain conditions which were there, with a view to boost the inflow of capital into the sector. Some of the conditions have been relaxed. One key condition which was there is if say a sovereign wealth fund or a pension fund were to invest into a category 1 or a category 2 AIF, the exemption was available provided the AIF would in turn invest 100% into eligible infrastructure companies. This has now been relaxed. So now the proposal is that at least 50% of the investment by the AIF should be into eligible infrastructure companies. So this is a welcome amendment because this gives some bit of flexibility for AIF to also invest into some of the projects which may not satisfy the eligibility criteria. Investment by an sovereign wealth fund or a pension fund through an investment company was not permitted at all. Now it is proposed that investment can be through a holding company. The condition in this regard is that the holding company should be set up on or after 1st of April 21, and at least 75% of the investments by the holding company should be into eligible infrastructure projects. Another amendment which is there was investments by sovereign wealth fund and pension fund into NBFCs or IFCs, which was not permitted. Now that is also permitted provided minimum 90% of the onward lending by NBFCs or IFCs is into one of more infrastructure entities. And the last on this slide, which is there, is on commercial activity. So there was a blanket ban on commercial activity to be carried out by the sovereign wealth fund or pension fund. Now, but sovereign wealth fund can, what amendment proposes is they will not participate in the day-to-day management or operations of the investee companies, but they will have right, or they may have a right to appoint directors in the investee companies. And appointment of directors on the board of an investee company would not amount to any running a commercial activity in India. So all these proposals which are there and some amendments which have been proposed in the finance bill are in that sense welcome move, and likely that infrastructure sector will see a lot more capital coming in. If you can move to the next slide, please. Can you move to the next slide, please? So, yeah, thank you. So some of the tax incentives which have been provided are with respect to the eligible startups. So, and capital gain exemption for investment into eligible startups. So these were all there in the act, and what has been provided is that they will be extended by 1 year. And I'll just quickly touch upon, if any eligible startup is there, there's 100% deduction of profits made by the startup for a period of 3 years out of the 10 years which was there, and for which the condition was that the startup should have been incorporated after April 1, 16, but before 31st March 21. So this has been extended up to 31st March 22. Similarly, if an individual were to sell a residential house or a house property, and the funds were proposed to be invested into an eligible startup, then there was an exemption provided from capital gains. That exemption was available up to investments done up to 31st March 21, which has now been extended to 31st March 22. Similarly, for affordable housing also there has been an extension. The tax holiday period which was available only up to 31st March 21 has now been extended up to 31st March 22. Also, there is a new thing which has been brought in is for affordable rental housing projects to be notified, where there will be a 100% tax holiday which will be provided. And also similarly, deduction of interest on loans for purchase of affordable housing, this has also been extended up to 31st March 22. So there is a 1-year extension which is provided. The third thing is that increase in the safe harbor from 10% to 20%. So there's a provision in the Income Tax Act which says that, like, if the difference between the price at which the real estate is sold and, like, the price which is considered by the stamp duty authorities, which we call it as the Reckner price. For the purposes of stamp duty, if the Reckner price is more than the price at which the agreement is entered, then for the purposes of computing capital gains and for the purposes of computing business income in case of real estate companies, the Reckner value would be deemed to be the full value. They had introduced a safe harbor of 10%, which was there, considering that the real estate transactions are not happening, and they're happening at a much lower value, and the Reckner has not correspondingly been amended with a view to reduce the hardship. It is now proposed to increase the safe harbor limit from 10% to 20%. So if there's a difference of up to 20%, then the transaction value will be considered. If the difference is more than 20%, then only the tax authorities would look at the Reckner value. Another thing which is there is enabling the infrastructure debt funds to issue zero coupon bonds, and some amendments in this regard are proposed in the income tax rules. And income of FII from securities, the TDS on that will be 20% under section 196D, or the treaty rate, whichever is lower. So this has now been clarified. Moving on to the next slide. I think we've missed one slide in between. If you can just go up 2 slides. Yeah. Okay, so there was this provision for rationalization provisions. So these are amendments which are there, which are going to largely impact the transactions. So this budget has clearly provided for tax treatment of goodwill. Goodwill, which is a self-generated goodwill, is not considered to be a depreciable asset. But the view which was there is that if a goodwill is acquired as part of a business acquisition, or a goodwill is recognized as a consequence of an amalgamation of two companies, then the said goodwill was considered to be an acquired goodwill and on which depreciation could be claimed. This has now been changed with effect from financial year, the current financial year, which is from 1st April 20. Goodwill is not considered as block of asset, and therefore any company which has a goodwill in its block and on which they were claiming depreciation, a tax break on account of depreciation may not be available. So this is one change which will impact several companies which have goodwill in their as a depreciable asset and on which they were claiming depreciation. Going forward, on slump sale, the definition of slump sale has been expanded to include any kind of exchange, relinquishment, or a transfer. This is done to mitigate the effect of some judicial precedents where it was said that if there is an exchange of an asset a transfer of a business, and the consideration was discharged in form of shares or bonds or debentures, then it should not qualify as a slump sale. So this has been done away with. Last year, there was an amendment in the REITs and InvITs, an SPV which were declared, which it will declare dividend to a REIT or an InvIT, there was a requirement to do a withholding at the SPV level, which resulted into a cash trap. So while there was no leakage per se, but it resulted into a cash trap and a timing difference for cash outflow. So this there were representations which were made, and this has been done away with. So they will be exempt from TDS. There's also an amendment which is proposed with respect to dissolution or reconstitution of firms. So if any dissolution or a reconstitution of firm and a partner would exit, then the difference which is standing to the credit of the partner's capital account and the amount that he gets would be considered as capital gains in the hands of the firm, and the firm will have to pay tax thereon. If any credit to the partner's capital account is there on account of any revaluation of assets or on account of creation of goodwill in the books, then the same will be ignored for the purposes of computing capital gains. One other change which is there is advance tax on dividend. Now that dividends are taxable, as and when corporates and tax payers would receive dividend, they will have to pay tax thereon. It was extremely difficult for an SSE to estimate in terms of what is the amount of dividend that they are going to receive, and therefore computation of advance tax was becoming difficult. So now it has been clarified that advance tax will be applicable only on declaration or payment of dividend. And last rationalization provision, which is the threshold limit for tax audit, has been increased to 10 crores or 100 million. The condition thereof is that at least 95% of the transactions should have been undertaken through the digital mode. If 95% of the transactions are not undertaken through the digital mode, then the old limit will still survive of 5 crore. Otherwise, the limit has been increased to 10 crores. If you can move to the next slide, please. Thank you. So there's other amendment which is there is on TDS. So currently there is a TCS which is applicable on sale of goods at 0.1%, and this is applicable from 1st October 20. Now, in addition to the above, a TDS is proposed on purchase of goods by specified buyers in excess of 50 lakh, and 50 lakh is qua the company from whom we are purchasing, at the rate of 0.1%, and 5% if the PAN number is not furnished. Now, this will be applicable only if the turnover of the company which is purchasing the good is in excess of 100 million or 10 crore rupees. And if it is clarified that if TDS is made applicable, then TCS will not be applicable on the same thing. So it will be 0.1% will be by way of a TDS. So this will increase some bit of a compliance on TDS return formalities for all the corporates. This amendment is going to be made effective from 1st of July 21. So till then TCS will prevail. After 1st of July 21, TDS will have to be done. Can move to the next slide, please. Okay, I'll quickly touch upon on the dispute resolution, and there have been certain changes. So there is advanced ruling authority. It is proposed that a new board for advanced ruling will be set up, and they will have more than one benches which will be headed by chief commissioners, and orders of advanced ruling will be appealable. So earlier the order of an advanced ruling authority was binding on the tax authorities, and they could not file an appeal, but there is a provision for that. They've also introduced a dispute resolution committee for small taxpayers who have returned income below less than 50 lakhs. And also there's a proposal to say that we will move to faceless tribunal, and a scheme in this regard will be notified by March of 23. And all communication with tribunal will be in an electronic form, and personal hearings, if necessary, would be on video conferencing. So physical hearings at tribunal will be done away with. We had settlement commission. The settlement commission as a body has been scrapped, and pending applications will be cleared by the interim board. And in terms of other amendments which are there, like, there is a reduction in timelines for filing belated returns. There's a reduction in timeline for tax authorities issuing notice for conducting assessments, as well as reduction in timeline for completion of assessments. So, like, this, and the reason for this essentially, as provided by the finance minister, was that everything is now faceless and everything is on an in electronic form, and it should not take time, and so they want to reduce the timelines every. And the last thing which is there is, like, the reassessment procedure has been completely overhauled. Earlier reassessment could be done up to 6 years, and as the assessing officer had to have a reason to believe that the income has escaped assessment, and this was subject matter of litigation. But now reassessment can be done only up to a period of 3 years, and assessing officer need to have evidence or proof to demonstrate that, the income has escaped assessment, and this has to be approved by the commissioner, and only in that situation can a reassessment proceeding be initiated. So these are key or select provisions which are there in the income tax amendments which are proposed in the finance bill. And over to Amit for indirect tax now.
Thank you, Shripal. Good afternoon to all the panelists and members of ICEMA. We will touch upon some significant amendments in the GST Act as well as the Customs Act, along with some tariff-related changes. To begin with, industry as a whole has been representing before the government, including ICEMA. There were representations on simplifying the input tax credit restrictions, more so because of the restrictions put from October 19 onwards. However, the most significant amendment in the CGST Act which has come is in the nature of putting a restriction on availment of input tax credit, and that is now possible only if the details of a supplier are furnished on the GST portal, and the recipient would be entitled to take credits post such submission only, which would mean that we can expect changes to the rules which were incorporated in October 19 once the budget is passed. And accordingly, there is a need for profiling of vendors according to their compliance status. And we could also look at more technology tools being used for doing such activity, because the onus of taking credits is only on the recipient, and to also ensure reasonable means that those credits are eligible ones. Moving on to the next one, the GST annual return audits, which are significantly delayed right from inception of GST, and we have had several extensions on this count. Now the government has decided to scrap the section which requires a professional certification of the GST annual returns, so the GST audit report, as pardon my. Now, that doesn't take away the responsibility of the taxpayer to still submit a reconciliation, and also puts the onus of self-certification on the taxpayer. So this is something which is also need to be understood in the context of the increased responsibility on taxpayers to comply with the requirement of self-certification of annual returns as well as audits. From a procedural standpoint, while we may see a change in the formats of 9 and 9C going forward, but if we need to also put into place a robust process of doing reconciliations by the end of the year. Moving on to the next important change in GST, if you can move to the next slide, please. This is with regard to the penal provisions while goods are detained when they're moving from one place to another place. What we have seen is there were quite a few options before the taxpayer to provisionally release goods and then fight with the authorities or agitate with the authorities with regard to the penalties or the non-compliance consequences which were imposed on the taxpayer. But what we see from the amendments which have been proposed is a significant and a steep rise in the penalties, and also doing away with the provisional release of goods, which could be done without payment of penalty, but those could only be done on payment of penalties by the taxpayer whose goods have been seized or detained by the authorities. In addition to that, for filing of appeals in these cases, there's also a mandatory pre-deposit of 25% of the penalty, which has now been proposed. So the objective of the warehousing or the logistics section, which looks after movement of goods, they would need to have proper processes and checks and balances to ensure that the mistakes which normally happen in the documentation or the gaps which happen in documentation for movement of goods do not result in the detention of goods going forward once these provisions are notified. The next set of amendments is with regard to the IGST Act. Now, most of the amendments in the GGST Act find mention in the 39th GST Council meeting, which was held in March 2020, and those amendments of the CGST Act and the IGST Act do have a mention in that minutes of meeting if you go through them in the detail. Pooja, if you can move to the next slide, please. Now, so the previous slide, please. Previous slide. So, in terms of the GST, the SEZ supplies, the zero dating benefit which was applicable for supplies to SEZ now has been restricted only for authorized operations of SEZ unit, which would mean that we need to ensure that the supplies which are going to be received by SEZ unit are only going to be used for their authorized operations. Secondly, the refund of GST on zero-dated supplies, there were two options, either to claim a refund of the input tax credit or pay the IGST on exports or zero-dated supplies and claim a refund of that. The government has decided to do away with the second option of payment of IGST, and it would be discretionary on the government to notify suppliers and also supplies, nature of supplies, which would be able to claim refund of IGST on payment of same while exporting goods or services. The next important thing is about the IGST on account of realization of export proceeds, wherein if we are exporting goods and we are claiming refund of IGST or of the accumulated supplies, in those cases, the realization of export proceeds would need to be done in terms of the FEMA Act. Now, this was there for services right from the service era, but for excise, there was a circular which was there which required exporters of goods to realize the proceeds within the time frame. However, this is now being brought within the ambit of the IGST Act, and this would mean the exporters of goods would need to monitor their export realizations within the time of frame of FEMA. Now, moving on to the next set of amendments for customs. Pooja, if you can move to the next slide. The important points on customs stand out in terms of the procedural and the legal changes. Now, highlighting a couple of them, like GST has been on all electronic filing right from its beginning, we are going to have an electronic portal which will be used for customs, bill of entry filing, shipping bill filing, registration, and even for submission of notices, etc. going forward. From a procedural standpoint, filing of bill of entries, the timelines for filing of bill of entries have been changed. While we could file bill of entries even within 24 hours of arrival of the shipment, now we would need to submit the bill of entries before the end of the previous day from the arrival of the consignment, which would mean advancement of the timing of bill of entries by about 48 hours. So here, the processes which a company has with regard to import processes would need to be streamlined, and SLAs would need to be relayed down to ensure this compliance. Moving on to the next amendment, which is about conditional exemption of customs. While there was an expectation the government would streamline a lot of customs duties, however, we have not seen too many changes in the effective rate of customs duties. And one of the possible reasons could be that the government is reviewing all the exemption notifications of customs, and as you would have heard the finance minister saying that by October 2021, about 400 customs exemptions would be reviewed and rationalized, and a new exemption mechanism would be brought out for the relevant exemptions. Now that also creates an opportunity for the industry to review the exemptions which they are claiming on imported goods. It can also lead to advocacy requirements for continuing certain exemptions depending on the needs of the industry. Furthermore, it is also important to mention that henceforth any conditional exemption of customs would be valid only for a period of 2 years, which would mean that if we are claiming an exemption for a business and we are looking at an exemption from a business decision-making perspective, we would also need to keep in mind the validity of the exemption, because it's going to be a time-bound exemption and not for a long run. Moving on to the next slide, please. We have also seen a lot of rationalization in terms of the procedures for the IGCR rules. It actually opens a lot of opportunities for the industry, wherein if we are availing customs duty exemptions and we are subject to the IGCR rules, in those cases, job work was not permitted earlier, now it has been permitted. Secondly, if we are importing capital goods, we could import capital goods, and when we dispose the capital goods, the customs duty would be paid on the depreciated value of such imported capital goods. Now, this also paves the way for advocacy in respect of inbound manufacturing, and we are aware that industry associations, including ICEMA, has been representing to the government for broad basing the inbound manufacturing concept to allow job works and also capital goods benefit. Now, this opening of the IGCR rules just create a more solid rationale for extending this to the inbound manufacturing facilities. The next important development in customs, which is going to happen from 2022 January, is the alignment with the HSN of 2022, which would mean that industry would need to look at their classification of goods, align that with the global HSN, and then the exemptions or concessions, and also, more important, the classification for bill of entries would need to be done in alignment with the new HSN nomenclature. Now, this would also mean that the processes like, or accreditation like AEO or Authorized Economic Operator, which builds in a lot of processes within the industry or a company, can also be looked at by the industry while taking up this alignment of HSN 2020. In terms of the duty rates, moving on to the next slide, please. While we have not seen too many changes in the effective customs duty rates, as I mentioned earlier, but going by the industry's demand, including ICEMA, with regard to reduction in customs duty rates, there have been some reduction in the rates, both for anti-dumping duty and also certain customs duty rates for alloys, non-alloy steel and steel, as you can see on the screen. In terms of other goods, moving on to the next slide, there are other items which are relevant for the industry and also for particularly members of ICEMA. The tunnel boring machines, we had a nil customs duty until 1st February. Now the BCD has been increased to 7.5%, and in components and components used required for manufacture of these machines have also had an increase in the customs duty to 2.5%. There are some other items which are used for could be manufactured for design for construction equipment, which could be relevant. Safety glass or consisting of toughened laminated glass, there also there's an increase in the customs duty from 10 to 15%. Interestingly, screw, bolts, nuts, which are there also we can see an increase in the customs duty rates from 10 to 15%, possibly indicating that India has got sufficient in-house manufacturing capacity on these items. I think we have come to almost the end. Pooja, if you can go to the next slide, please. So in terms of the increase in customs duty rates, you can also see that some of the items which could be applicable, there are some increase. But as I said earlier, that we can look at a more rationalization and also a more evolved way of looking at the customs duty rates once the HSN exemption review is done by October 2021. That brings us to the end of the indirect tax proposals. I hand it over to Bela for conducting the session further. Thank you.
Yeah. Thank you. So thank you to to Ishwar, Amit, Shripal, Gokul for a very comprehensive analysis of the policy announcements and tax proposals. And with that, we now move on to our panel discussion. And for this, we do have the industry leaders joining us. We have Mr. Sundareshan from Amman, India. We have Mr. Venkat from Tata Hitachi, Mr. Iyer from Volvo, and then we will also have Mr. Bakshi joining us for a bit, and then Mr. Ishwar and Gokul as well as a part of the panel discussion. So let's get into the discussion. But in the interim, if there are any questions that any of the participants do have on anything that you've heard so far, please put them in the Q&A box, and I will try and address it during the panel discussion or during the Q&A session if we have some time. So beginning with the panel discussion, Ishwar, I'd like to come to you first. Investments announced in the union budget this week, what would be the key sub-segments of growth in the Indian construction equipment industry, and what would be the key growth drivers? Ishwar?
I think very clearly. Thank you, Bela. Am I audible? Am I okay?
Yes, you're fine. Ishwar, we can hear.
Yeah. Am I audible, Bela?
Yes.
I was not sure. Yeah.
Yes, you. Yes, you are, Ishwar. There's some audio trouble we are having with Ishwar. Just give it up. YouTube. Should you want to switch off your video and try? Okay, I'm sure. Ishwar, are you with us?
I'm there, Bela. I was not sure whether I was being heard. So, yeah.
Oh, you are heard only now. You said I'm there, Bela. So that we didn't hear anything if you were speaking.
Okay. So, a couple of things which would be of significance in the budget for us. I think the first thing really is around the sectors that we spoke about. I think one of the biggest parallels that I'm able to investment is the parallel that we had when Shanghai was being built, which is between the late 90s and the early 2000s. And if we were to take the portfolio of the members of the ICEMA, then out of every 3 backhoes in the world, 2 of them were in Shanghai, literally. And out of every 3 hex, I think 1 of them was in Shanghai. So to that extent, I think just giving you a context of what it is. And to that extent, I think one of the biggest drivers for us would be the fundamental requirement for prime products. The only change that I see is that customers today would start looking for more innovative pricing models as they go by, because these are all going to be contracts with specific periods of time that will come in. And therefore, what I foresee also for the marketplace, and if I were to take parallels from other parts of the world, I think customers would start looking for innovative pricing models, which could either be converting a lot of fixed into their variable subscription-based equivalences, or for that matter, things tied to outcomes rather than outputs. So I think these are possibly the areas of consideration, but otherwise, my view is that the market is very strong to go forward with the vision. The only dimension would be the way in which customers would start looking at the portfolio and the pricing.
Thank you, Ishwar. So, Mr. Venkat, with that, I'd like to come over to get some industry perspectives. From what you've heard, during the presentation and from Mr. Ishwar, do you think this would result in some operating model changes or revenue models for companies, new revenue models for companies? And will organizations need to look beyond traditional hire purchase lease models? Mr. Venkat?
Yeah, thanks, Bella. If you look at the sector, you will always have customers of varying profile. Some would like to be asset light. Somebody would like to be owning the assets because it has a bearing on their borrowing capabilities. Many of them would some would look at rental options because cash flows are limited. But if you look at the supply side of funds, there's going to be a huge surplus of funds which are going to come from the banking sector. If the bad banking concept has been picked up by a government agency, an asset reconstruction company, the banks are going to also get capitalized by 20,000 crores. So that's going to create a whole sort of funding available to the banks. So, and the National Highway Authority of India have gradually moved towards ring fencing projects, cash flows, so that you prevent diversions from one to another project of the contractor. So these are all changes which have happened in the last few years. So they would, I don't see too much of change which will happen. But as Ishwar said, there will be end outcome based proof which will have to be provided by the OE players. And if the products can deliver on those commitments, people should be willing to lend. So the sum and substance of it is it's not going to change dramatically the operating models in the industry.
Thank you, sir. Mr. Iyer, now if I could just come over to you, and how can organizations configure themselves for the growth and leverage, for a positive impact on this budget? What are the aspects you recommend, for leveraging the policy environments? Mr. Iyer?
Yeah. So yeah, thanks, Bella. So I mean, continuing in what Ishwaran and Venkat both were talking about. I mean, the opportunity for the industry is going to be limitless. And if going by what Ishwaran was saying, that every second backhoe was in Shanghai, probably every second backhoe will be in India if things fall in place and the execution pace is at the same pace as we all wish it would be. So given that, from an industry perspective, there will be a couple of points. I mean, let's take the case of when COVID hit us and then the V-shaped recovery came back. Our supply chains were completely stretched. We were, and are still stretched. Most of us are scrambling to deliver our products right now. So that part of the strengthening will have to happen. As Venkat was saying, the stepping in of the government in taking away, clearing up the bad loans should help easing out the credit side of it, and which means that we will be able to also make the right product available at the right time. The other key challenge that we will have as OEMs is to maintain the uptime in the service side. When the machines are in use, the pace is so fast that you will have to ensure that the delivery and the uptime is far superior than what we are today at industry standards. So that will be this other area. And lastly, I think depending, we have our business models, but one of the business models I think which will come into play with credit being available will be the subscription model. And I think that is something as an industry we will have to start preparing for, because I think that will be something the customer, our end customers will be looking at. Sure.
Thank you, Mr. Iyer. Ishwar, we've heard, from the industry leaders. Do you have any reflections on what we've heard, and also, would like your views on what would be the collateral impact on the industry from the MSME reforms as well?
I think Mr. Iyer touched upon it just a minute back, right? One of the fundamental things that we have, because we are also on a shared ecosystem, right? I don't think at industry level today we are in a situation to have exclusivity of the entire. I think that is still to evolve. Maybe on the distribution side of things, but not so much on the supply side of things. And one of the big areas that would be a focus would be really looking at how the supply side resilience is able to build in competitiveness for companies. Just like what he said, the front end is available for us in terms of the market, but the back end in terms of what can be supplied is still a little bit, wobbling. And therefore, if that were to be corrected, I would say that the reforms of the MSME, and I'm particularly happy that most of the reforms are fiscal rather than monetary in nature, which essentially means that it can help the balance sheet rather than short-term fixes of working capital in these companies. And to that extent, I think the MSME direction is very important for the larger industrial manufacturing ecosystem. And I put ICEMA in perspective there because our supply chains are not exclusive right now. So to that extent, I would say that this is a pretty important direction for us to move. And as it was said before the budget, this is just not announcement only in the budget. Some of this were continuations from the past. And I would assume that in the next 6 months to 8 months, as companies go through the cycle and as the front-end prime product producers and brands, we are able to also provide reliability of demand into the supply side together with the availability of capital is really going to be helpful. That's the way I would look at the whole. To me, it's an important requirement to ensure that the supply chain is available and effective for the growth that we are targeting in the construction equipment space.
Right. Thank you, Ishwar. Mr. Sundaresan, coming over to you now. The government is committed to achieving its national infrastructure pipeline, as Ishwar had also sort of detailed in his presentation, and has taken certain steps, to achieve this vision. So, I request you to share your views on the NIP target and the specific policy announcements to achieve them.
Yeah, the NIP target is very ambitious and it's now covering almost 7,400 projects. And the government is definitely committed to this. As you can see that they have already completed about 217 projects worth over 1.1 lakh crores. So all these targets require substantial increase in funding both from the government and the financial sector. They have taken concrete steps to do this by creating institutional structures, by monetizing assets, enhancing shares of capital expenditure. Since infrastructure needs long-term debt financing, the government is also likely to introduce a bill to set up the development financial institution and have provided about 20,000 crores to capitalize this institution. The ambition is to lend about 5 lakh crores in 3 years' time. The national monetization pipeline of potential brownfield infrastructure assets will be launched. There is also a sharp increase in capital budget. The government has provided about 5.5 lakh crores to capital expenditure for the year 21-22. So government will work out specific mechanism to nudge the states to spend more budget on infrastructure creation. So by March 2022, government is likely to award 8,500 kilometers under the Bharatmala projects. And besides that, there are some other projects like 3,500 kilometers of national highway works in the state of Tamil Nadu for about 1.03 lakh crores, 1,100 kilometers of national highway works in the state of Kerala for 65,000 crores, 675 kilometers of national highway works in the state of West Bengal for about 25,000 crores, 1,300 kilometers of national highway projects in the With all these initiatives, the construction equipment industry is definitely upbeat, and we foresee the industry to grow considerably in the years to come. So we are quite happy with the announcement on this budget. Having said that, there are also issues. There are also certain areas which is not addressed. Today, we are facing real problem with respect to availability of steel. And we expected that we had represented, including the Honorable Minister, Mr. Nitin Gadkari had also mentioned that there is no reason why the steel price should go up. And for all these machines, all these construction costs will go up like anything unless the price for the steel is controlled. Of course, it was partly touched. They have, suspended the anti-dumping duty for steel up to September. But in my opinion, that's not enough. Even today, still we cannot import steel, basically because we have to comply with the highest standard specification. So if that has to be done, that's going to be difficult. And today, the steel is already at 25%, more than 35%, from 45 rupees what it was in the couple of months back. Today it is at 60 rupees a kilo. So it's really very, very difficult for us to, produce equipment and supply. Definitely the construction cost will go up, and necessarily something has to be done in this area. So otherwise, yes, the budget is fantastic. We are all quite happy about the budget. Our industry is likely to grow tenfolds, I would say, in the next few years, no doubt. That's all from my side. Yeah. So we look at it very positively.
Yeah, thank you, Mr. Sinha. What we've heard from industry leaders is that the budget is very positive for this sector. Some more areas where actions are still required, but overall it seems that the industry is very gung-ho. And as you had said, Mr. Bakshi, that you could become a USD 20 billion industry, in the next 10 years. Maybe you could achieve it earlier, is what I'm hearing, right? From provided we get it, we are able to achieve the targets laid out in the policy announcements. So, Mr. Bakshi, coming over to you, as has been mentioned, the debt fund, the setting up of the development financial institution. How do you think this will sort of benefit the sector? What are your views?
Yeah, Bella, I think it is a extremely great move from the government, because ICEMA has been pitching for this for a very, very long time. We have been writing to various ministries actually for this. See, financing a long-term infra project is very, very different from a normal lending for a normal business activity. The risks involved are very, very different. Particularly when it is a greenfield or a brownfield project. The risks are very different in comparison to, say, an industrial lending. The risk can be, construction completion risks, operating risk, demand risk. We saw that during the COVID time. Suddenly, the toll roads which were running very smoothly, suddenly the demand went off. Force majeure, and the change in law. And we have seen that in some of the state governments actually, wherein suddenly, when with the change of government, suddenly the projects were, had taken a different shape basically. So there are political and regulatory risks. There are expropriation and nationalization risks. There are environmental and social risks also associated with any kind of infra project. So what we feel is a bank which is having a depositor's money probably may not be the right institution to take such long-term risk basically. See, although the concept of DFI, of course, even in India is not very new. In fact, IFCI, was formed in 1948 with the same mandate. Even ICICI, today's banks like ICICI and IDBI, ICICI was formed in 1955. IDBI was formed in 1964, mainly as DFIs only, and they have done their jobs. But today they are banks, so the agenda is very, very different. So today, we do have institutions. We have institutions like IFCL, PFC, REC, but they have a mandate, they have a capital, they have a mandate to basically cater to a particular sector. So what we feel is this announcement is welcome, because this will bring in a scale. So we are talking about, say, 20,000 crores capital, and a lending target of about 5 lakh crores, which is the kind of investment which is needed in infrastructure. You cannot work with a 30, 40, 300, 400, 600,000 crores. We need this kind of an investment basically, which is, it is done by the government itself. So if DFI is promoted by the government, of course, the ratings will be very different. The source of financing will be very different. So to make it successful, I think the skill sets of risk assessment will have to be worked upon. Basically, in terms of, I told you about the various risks that a project financing has it. So so the skill set to assess those kind of risks, whether it's project or credit risk, is very, very important. Also, the institution will have the flexibility of the changing need of financing as the project moves forward, or if any unseen risks that is, or unanticipated risk that comes, this institution will be able to take a corrective action. Today, if you have to restructure a loan, it is subject to various provision norms and various sometimes very difficult draconian provisioning norms basically. So, but these institutions will be, will be designed in a way that, they can cater to these kind of changes if that happens. They will have the capability to raise finance, not only from India, but also from outside the nation. So today, another thing I think which has to be coupled with this is developing the bond market, which is very nascent in India. If the concept of DFI and the bond market development is done, I feel it can be a deadly combination. And DeFi can work as a catalyst and would fund the projects, where the banks will not be able to enter. Once we have these credible institutions, we can, like Eastman was talking about, attracting pension funds, insurance companies, asset management companies, and even household savings into this sector. Basically, once we have this DFI, so to sum it all, basically, we welcome this move, and it's a wonderful announcement with the government, and we are totally on for it. Yeah, Bella.
Thank you, Mr. Gokul, coming over to you, you sort of had spoken on certain other financing proposals that are there in the budget besides the DFI, like InvITs and asset monetization and all other measures, including the tax relief measures. So can you share some more views around, first what Mr. Bakshi has said, and also on the other measures as to how that will help support the growth of this industry? Gokul?
Sure, Bella. Bella, what Mr. Bakshi said is very right. He spoke very comprehensively on this. I think we need to recognize that there's a life cycle to an asset, which starts from the construction all the way where project finance is sort of raised, and the greenfield asset has its own set of risks. And then it goes into becoming a mature asset and so forth. And then, of course, you need to do an O&M phase to that asset. I think the government has recognized that as you can't have the pension funds and the sovereign funds coming in at the front end of this life cycle. They will not take the development risk because they are not in the business of taking development risks, which is there. But they are certainly able to provide very large sums of money, very stable sums of money for a very sustained period of time for holding the asset and making sure that the asset, whether it's a toll road or it is a port, or etc., is able to run its course. So they're able to provide funding and financing, which is extremely important for brownfield assets. So I think when we look at this budget and the various pieces that the government is trying to stitch together here, which is to try and make sure that there is an asset monetization policy, which is there, that there will be the relevant instruments by which the investment will happen, which is the InvITs and the REITs, and then the right investor class, which is pension funds and sovereign funds, will be invited into that. Portfolio investors will be invited to put in debt if required. So I think these are all measures which recognize that you need to bring in sufficient amount of channels of capital for holding the asset, and it's not possible for the government to undertake both the development of these assets or through its various authorities, and also be the holder of these assets, because that locks up their capital and does not allow further growth of the sector. So I think this will introduce the mechanism for liquidity to grow into this sector and thereby improve the health of the sector. So I think this is a great move.
Thank you, Gokul. Mr. Sundaresan, do you have any further reflections on these aspects, the financial aspects of the proposals for the sector?
Yeah, I have really nothing much to add. As already mentioned, infrastructure requires long-term debt for financing. Therefore, setting up this development financial institution with a capital of 20,000 crores to fund over 5 lakh crores of infrastructure project in the next 3 years. This is going to definitely help the projects, and it will in turn help the construction equipment industry. Though the funding is very modest to start with, I'm sure that over a period of time, definitely they will further increase this, and it will really help the industry to grow. Sure.
Thank you. Thank you. Now, moving back, I think let's sort of move to some of the tax issues that the industry faces, and let's focus on a few of the key ones. So, Mr. Venkat, the industry has been asking for rationalization of GST rates on construction equipment, and in certain cases, these are also subjected to inverted duty. And now the finance minister did in her speech mention that she would look at all the inverted duty structures and maybe we will get some response on that. But overall, the rationalization of rates that was sought for has not really happened. So considering the focus, of the budget on the infrastructure sector, how imperative it is to get these rates rationalized for the growth of the sector. Mr. Sundaresh? Mr. Venkat.
Yeah. Balath, I think the going in position as far as the construction equipment industry is concerned, I don't think we have an inverted duty structure because most of the inputs are at 18% or little less than that. But I think largely most of the components are at 18% and our end product is also at 18%. The only area where the components are at 28 are where the nomenclatures are very similar to what is being used in the automobile industry, especially the engines, pumps, etc. These are the only component because the government cannot make a distinction on whether the engine is going into a commercial vehicle or a passenger vehicle, or is it going to a construction equipment, or a pump or a cylinder which is expected to go into an automobile can also go into a construction equipment. So it is to do with the HSN code, which is not still categorized specifically for construction equipment. So I think it won't be right on our part to insist on reduction. But whether we will get any reduction, I think our friends in the automobile industry are in any case clamoring for it. And if it happens, it automatically comes back to us. So I don't think we need to be doing anything specifically for, lobbying for reduction in the GST rate on certain of our components. 18 seems to be the right fit. And with tax buoyancy and compliance improving in the future, I'm sure the government is committed that we will move to a lower duty structure in course of time. If you remember, the earlier lobbying was that we are for infrastructure and it is critical for development of India, etc. And we were lobbying for 5% and all that. That would have been misguided because many of the components would have been at 12 or 18% and our output would have been at 5%. That would have created a problem of inverted duty structure, and thankfully we are at 18. And if you look at the erstwhile taxes, the average, the excise duty or service tax, which was around 12 to 15%, and the average VAT rates were around 8 to 9%. So actually we have come down from a 24-22 regime to 18%. So I think where we are is the right pitch. And if the automobile lobbies and gets their GST rate reduced to 18 bracket, we automatically benefit. So I don't think we need to be doing anything specifically.
Right. So, yeah, I think that very, very logical. And as you rightly said, the health sector is where we are finding that the health sector is really stuck with a lot of input tax credits, primarily because of the exemptions or the lower GST rates that they are subjected to. And it's good we are not in that place. So moving on, the inclusion of petroleum products into GST has also been a key issue for the wider industry, not just for the oil and gas sector itself. So, Mr. Iyer, what does the exclusion of these products also impact the industry? So, you all are not the oil and gas sector, and we've been having a discussion with PP as well. But we do understand that the wider industry is also advocating for these products. Yes.
Right. So, I mean, let's look at what are we trying to achieve by asking for inclusion into the GST scheme, right? I mean, today the tax on the petroleum products, including the excise and the VAT put together, which is not claimable under the GST regime, as a set off amounts to almost, let's say, 50 to 60 rupees per liter of the petrol. Now, looking at what the government could do is that maybe rationalize this and bring this into a GST regime. While they could do that, they need to worry about right now that there are only two big commodities which are helping the states with the GST revenue, which is the alcohol and the petrol side of things, right? So given that, they will have to find a compensation to do that. Secondly, even if we bring it to the GST regime, right, there is no assurance that we will get it to the rate of 28%, or if it comes to 40% with a levy of a surcharge on luxury item and stuff like that. So that is not there. So for me, it is that where we end up even in the GST, that becomes critical. From our industry perspective, what happens is that our customer or the utilizer of the our products, for them, the cost of fuel is nearly 40 to 50% of their input cost. And consequently, the pressure on reducing cost is left on the end equipment that they use when they buy it from us, putting a reverse pressure on us to find a cost efficiency in our products. So, which I think we should find. From a larger picture, what I feel the GST introduction of petroleum products into GST will do is to harmonize the pricing across the country, and which means that the development across the country would be more at a better, more harmonized rate, instead of, let's say, having a road construction costing X in Assam while costing Y in Maharashtra or Madhya Pradesh. So that's what I think we should be looking at. And I mean, they are still going to look at it. Mr. Pradhan was talking about looking at it in the July 21 period. So let's see what comes up from there.
Right. So it's just a larger value chain also, which gets impacted on this industry.
Yes.
Another important, amendment that has come about in this oil and gas products is around, on use of CFOMs for interstate purchases of products. I don't know if that is relevant to your industry, but the key one that we have picked up is that CFOMs, which give you a concessional tax rate, can only be used by resellers or refiners of those byproducts. They can be used by any industry. So, for example, LNG used by the fertilizer sector, they will no longer get a CFOM, and they have to buy it at the normal flat rate in our state, which is up to 23%. So, is there an impact of that change for your industry?
Yeah, I mean, again, as fuel becomes an input cost for our customers predominantly, that cost will go up. And unfortunately, that is a reality that we will have to live with, given that there will be no concessional rates. So that is something that will put a pressure back on us as an industry to, as I said, because there are two big components. One is the fuel for our customer, from a customer perspective, and the hard machinery that he buys or invests in. And since these are the two key components, the other one side will have to be compensated by the other. So that will be a pressure back on us, and we will have to find innovative ways to solve and help our customers out in that regard.
Gokul, just some more, since you've been associated for so long with the oil and gas industry, any views you have on what you heard, attentively on the exclusion and what you heard from Mr. Iyer as well?
So, from a supply chain perspective, I think it makes eminent sense that all products should come into the GST net and therefore become a seamless mechanism of credits, and therefore that is the ideal thing. Now, given the revenue imperatives that the states have as well as the center have, two sort of points I have here. One, when I look at the finance bill and the accompanying documents, one interesting statistics that comes in is that in the year that the last full year that we had of excise duty in this country, we collected about 3,80,000 crores of excise duty or so. This year, we are collecting 3,60,000 crores of excise duty. So therefore, if we look at it, the petroleum sector, which is one of the prominent sectors still liable to excise duty, is today virtually contributing 90% of the excise duty that the country used to collect during its regular years before GST. And if we combine the GST collection that the government is anticipating, which is 6,30,000 crores next year, the central government, and then we add to it the excise duty that they're planning to collect from this petroleum sector, which is another 3,40,000 or 3,60,000 lakh crores. There is nearly a 55% increase in revenue collection that the government has as an aggregate over what the pre-GST numbers were. So the first fact is that there was this whole anxiety that the government had that we will, have huge loss in exchequer potentially with the migration to GST. I think until a white paper comes in from the government, which shows us what the revenue implications are. I think 3 years we have experienced GST. I think it's a fair time for us to actually see whether such a document comes. I think GST has been, good and for the economy, and it has been stable revenues for the government. That's sort of one piece that I'd like to state. The second aspect is that the expectation was that some of the petroleum products such as natural gas and ATF could be taken in first by the GST Council into the GST net. And I know, Bela, you did human service to the sector at those years by making sure that petroleum products work in the enabling framework for GST and not constitutionally debarred. So I think if the GST Council would now move towards bringing in natural gas and ATF in the first instance, and then moving to the rest of the petroleum products, at least it will be a progressive sign here. So I think that's the point that I have. I think the revenues are looking strong, but I think the reform process should continue.
I think, all of us are working in that direction, and we hope the government does sort of see the merit in it. So, we will come to, one last question for the panel discussion, and then I'll take up some other questions that have come up, from the presentation. So, Mr. Venkat, there is one other provision in the, under the GST law proposal, which will further further restricts the credit, that can be taken by the industry, and in your sector, more importantly, because you do have a vast MSME kind of, ecosystem. So, where now they are saying that you require 100% matching of the invoicing and the taxes to be paid by your vendor before you can take the credit. So how do you see that as a big impact on the industry, or it's since some of these provisions were already there, it's not really materially going to impact the industry? Mr. Venkat?
Well, this would actually appear to be a working capital impact area, because till the vendor who's supplying and has filed his return and it appears in the GST portal against my name, I would not be able to avail of the credit. That's the sum and substance of this particular new section which has been inserted. Section, if I remember right, is section 16, subsection 2 AA or something. Now, you have to see it in the context of where the government is moving. If you recall, the e-invoicing mechanism has been introduced from October. They have said 500 crores and above entities will have to go on to the e-invoicing mechanism, which means that at the time of billing, the data is populated onto the portal and you generate the QR code and the 64-bit data, which is what you use for matching at the receiving end. And the 100 crore criteria has been introduced from 1st of January. And there is a commitment that everybody would be moved in from 1st of April. So we are hoping that they stick to that commitment, and politics does not come in the way of postponing that particular element. But if you see in the context of the new QRMP rules, the quarterly return monthly payment rules, which are coming from 1st of January 21, this is applicable for all registered payers who have less than 5 crore turnover. So these people have the option of filing their quarterly return and making their payment on a monthly basis. There are various schemes on how I can pay, whether self-assessment or whatever. But till they have filed their return, this is not going to figure against my name. But under the same rules, the government has also introduced invoice furnishing facility, IFF, where the vendor can upload all the invoices pertaining to the various GST registered persons, and he can file it with the government. The moment that is filed, it gets reflected as my credit. So if you, given all this in perspective, the role which all players need to make is first do a cut and splice of my vendor base as well as my service providers, see where do they fit in. If people are already in 100 crore plus bracket, they are already covered by the e-invoicing. There's nothing much to be done. It will automatically come onto my portal. If they are not migrated to the new e-invoicing system from 1st of April, those are the fellows you need to be worried, and look at the 5 crore people, 5 crore turnover registered people. So every OE player needs to cut and splice their vendor base and the service materials and service providers and take a look at all this. And we need to build up on our own because it is for our benefit. We need to find a way by which we facilitate the vendor to file the IFF. So if we take care of these things, I am sure we would be able to ride over this problem. But the intention of the government is that till I have got the money or I have a hold over somebody who is supposed to pay me tax, I will not allow this amount to be picked up. It's very different from the regime of excise duty or service tax, where I could take on the strength of my invoice of the vendor, and that is subject to a post audit, etc., for show cause notice, etc. But today they are saying a GST invoice is equivalent to a check or to cash. So therefore, if somebody is raising a bill on you and based on which you need to take, I need to show in my portal that it is due to me, due to the government. So I think that's the company which is there. But if we systematically do the cutting and splicing of vendors and service vendors and material vendors, I don't see this to be a major issue.
Right. Yeah. So there an action on the industry that needs to take to ensure that you don't get into a liquidity or a cash issue. And clearly the government has sort of tried to make the system cohesive, to try to say, you know, we all take care of each other, right? It's not just the government's duty to do it.
That's right.
So with that, I think we've come to the end of our panel discussion. We do have some questions. This is to you, Shripal, and it is about on the goodwill issue, where the industry is likely to take up with the government non-applicability of goodwill depreciation prospectively instead of retrospectively, as most have paid advance tax, and where the deductions already considered. Is industry likely to take it up with the government? Shripal, then maybe you want to introduce as well.
Yeah. So Bela, industry is certainly likely to take it up with the government, and the representations are going to be twofold. The first is that make this prospective, and or rather the first one will be that you see the loophole which the government wanted to plug was when there are group company amalgamations which are done, and in the process a goodwill was created artificially and on which tax break was being claimed. Now while they wanted to fix this, the way they have fixed this is they have removed goodwill completely from block of asset. So the industry is going to make a representation to say in case of an acquisition of business, where I've actually paid money to acquire the business and the difference goes into goodwill, that should be allowed as a deduction. And only if you want to restrict, you restrict goodwill on amalgamation. And if that is not accepted, like, the second representation which is going to be made to the government is that you should make this prospective, because otherwise it is going to put a lot of SSEs who have already claimed goodwill, or, like, because they have done acquisitions in past on which the goodwill has been recognized. There's going to be a huge payout in the last quarter, as well as there's going to be an interest penalty interest under 234B and C. So this will be taken up by all the industry forums.
So, Bela, Shripal is right. This is not the only provision which has been given effect to in this manner. And I think in the spirit of thing where this government has always said that we don't do anything to create uncertainty for taxpayers, and we will not create retrospectivity. I think these provisions should logically be pushed forward by a year in the implementation. But I guess, or at the very least, they should be constrained to only those places where the government actually wants to have anti-abuse provisions being introduced. But I think it's going to be, I would give it less than a fair chance because I think the government is unlikely to give in to too many rollbacks in this budget. One other interesting anecdote, and it's not connected to this question, but it certainly sits in the budget document. So in case people have picked it up, it's great. When I was reading the budget documents, one of the things that I came across was, and Mr. Bakshi would be interested, there are 71,000 corporate taxpayers who list their primary business as construction. And these 71,000 taxpayers have reported 64,500 crores of profit before tax. The interesting data that I have is that for a large number of these taxpayers, the effective tax rate is sitting at about 30.2%, which is 2.5% higher than the general mass of tax returns that have been filed for the corporate taxpayers. So the general effective tax rate is about 27%, and the sector is paying about 30%. Now, I don't know where this data point can be effectively used by the community, but it certainly shows to me that the construction industry is certainly one of the taxpayers, a community, which is paying more than the effective rate by nearly 3 percentage points over others. So back to you, Bela.
Yeah, from Mr. Sundaresan. I hope you got your response, sir, from Shripal. And with that, I think we come to the end of the panel discussion and the Q&A, and I hand it over to Mr. Bakshi for the rest of the session.
Thank you, Bela. So, Ishwaran, Gokul, Bela, Shripal, Amit, Mr. Anand, Ms. Venkat, Ms. Murli, thanks a lot. Thank you for taking our time from your very, very busy schedules and sharing detailed insights on Union Budget 2021 and for joining for the panel discussion. Special thanks to all of you who have joined us on this webcast and seeing us live. A very useful and to the point and very relevant presentation as well as panel discussion, I must say. I also thank Sandeep, the co-convener of Finance Panel, and the Finance Panel for all the support. In fact, the DFI idea, was pushed by Mr. Vyas from Shrey and Sandeep in a lot of forums. And ICEMA, as I told earlier, like we pushed this a lot in to the various ministries. Thanks a lot, Sandeep. Thanks to ICEMA GC members. Deepak joined in for the meeting. Thanks a lot. And thank you, ICEMA Secretarial, Seema, Paramita, Sumita, for putting up all this together. The webcast and the archive link and the presentation will be shared with you shortly. In case any of the members have any queries or want to know any further about any of the ideas that was shared, please feel free to get in touch with ICEMA. So we will come back to you. Before we close, if I may request all the members, to kindly. Okay, so we have taken the photographs. Thanks a lot. Thank you, and have a great day. Thank you. Thanks a lot. Thank you, everybody.
Thank you.
Thank you.